up some more information which picked up the gender diversity of the boards of listed companies in 2020, and then to share with you some of our collective insights and food for thought. So let me just jump straight into it. And let me just say before unveiling the results that the methodology that Ron outlined, when we completed our initial assessment, we shared the results with each company individually, and each company had an opportunity both to see the instrument and to question us as to how we arrived based on their annual report at the scoring that we did arrive at. There was very little contention, let me say, because as I say, the object of the exercise is to raise the standard of governance practice. So the results, when we compared the companies listed on the Trinidad and Tobago Stock Exchange using their annual reports for 2020 against the international benchmarks that we gathered, this was the ranking that emerged. Out of a maximum score of 29, a note at the top, you'll see NCB Financial Group, JMMB Group Limited, and Massey Holdings really led the way. Their reports were fulsome. They went not only into reporting that they were doing an activity, but some went into the impact of the activity as well. What we are hoping is that what we have aimed, how we've structured today, is so that these companies would actually share with the rest of us the approach that they have taken to governance and the importance and how it fits with their delivering their business strategy, which has led them now to the point where in our ranking, they actually lead the way. That's against the international codes. If you're looking at the results for all the companies that we looked at, this is the result when we rank all the companies. You'll see the top three there, followed in various degrees by the other companies. And one of the insights that we learned from this as well is that there needs to be special cognizance given to companies who may not be operating entities, but more of an investment nature. But that's something we can discuss when we get into the question and answer session. When we look at these are the most common disclosures. So for instance, these are the disclosures that most often appeared in each of the reports. All but one of the reports indicated whether their CEO and chair role was occupied by two different people. Good practice from a governance perspective encourages you to have those roles occupied by two individuals. And where due to the company circumstance, it's not possible, because some companies, like for instance, Marks and Spencer's in the UK, went through a period in their strategic development where it was actually made sense for a brief period to actually have their CEO and chair as one person. Good governance guides, because that's what good governance is doing, guiding you. Good governance guides that in those circumstances, the company is encouraged to make sure that there's a senior independent director on the board of such gravitas and experience that they could counterbalance the concentration of power that is perceived to exist in one position when you combine the CEO and chair's position. Again, it's perceived in governance terms to be a risky thing to do. So therefore, in the governance field, we also suggest, well, how can you mitigate and manage that risk? Because nothing about governance is black and white. Other common disclosures, many companies talked about the CSR data. And I call it CSR data deliberately as opposed to information, because there was a lot of reporting of activity, but little reporting on impact, and little reporting as to how the particular CSR program or employee engagement actually tied back to advancing the particular strategy of the company. It may sound obvious, but it wasn't stated. A lot of companies are sharing the competency, skill mix, and basic demographic data about their directors, which is a really great step forward. Many companies are actually sharing it for photographic pictures as well. So here we have an ability to look at, well, who was actually in the leadership and who's leading this organization. Most companies, except one, declared the shares held by their directors. And corporate governance activities were reported quite widely. So most companies reported on their which committees that they had, which committees existed, how those committees were made up, who chaired the committee. And in some of the better reports, they actually gave you a body of work that that committee would do. So they didn't just say, well, we had an audit committee. They said, look, this is the body of work that the audit committee undertook during the year. Or if they had a nomination committee or a governance committee, this is the body of work that committee undertook. It doesn't take a lot. You don't have to go into a lot of detail, but it very much gives a much more granular insight to how the organization is being led. When we look at the Trinidad and Tobago Code, and the Trinidad and Tobago Corporate Governance Code was published in 2013, which is a point I come back to at the end of my presentation, because one of the pressing issues is that we need to update that code. When we looked at the code, and for those unfamiliar with the code is structured around 5 principles. And then you also have guidance with regard to how you can apply those principles. And most definitely, you're given further information as to some of the practical issues and insights in applying the governance principles. When we looked at the annual reports for the companies quoted on the stock exchange for the 2020, this was the ranking. Out of a maximum score of 23, there's one company who actually ticked all the boxes, in terms of what needed to be declared. As the instrument is developed, we will be getting more rigorous with regard to the measure that we're using to judge compliance. But at this point in time, the narrative describing, getting into a bit more detail about how the particular principle has been applied within the company is the yardstick that we have used here. And we would hope over time to see, well, that one, everybody will move up the scoring. In addition to that, we will actually be advocating very strongly that the code is brought up to date in ways that I'll talk about later. So this is the result. So when you look at now the result for all the companies, this is how they fared. You have the top 3 at the top, very closely followed by a bunch, and then at peters out, you will see here that we haven't analyzed it by manufacturing or banking. These are improvements that we'll do as we report in future years, so that you can have a sector ranking as well as an overall ranking. This is we're just showing you here side by side. If you look at the top 5, you'll see the top 5, whether it's international codes or local codes, the top 5 are the companies within the top 5 are pretty common, which is what you would expect. When we looked at the Trinidad and Tobago Code and the 5 principles, we were also in a position to assess the percentage of compliance, the degree of compliance overall for all of the companies we looked at. And what we were very pleased to find that when you look at establishing a framework, that principle, and so for instance, one of the examples of what falls within that principle is that the chairperson of the board should be a non-executive director, and preferably an independent director. Where the chairperson of the board is not an independent non-executive director, the board should appoint a lead director. There are 5 guidance notes with regard to the application of this principle. And we found, when we looked at the 5 and we looked at the performance based on what was reported in the annual reports of the 27 companies, we found as high as an 82% compliance with this principle in the code. Yes, there are improvements, and we can point to improvements that can be made, but we thought that showed how applicable that the code is being used, number one, and that there is benefit in actually looking at how the code can be implemented within your company. When we looked at strengthening the composition of the board, the overall percentage compliance wasn't as high. Let me give you some examples of what falls into that principle. Directors should be selected and appointed through a rigorous and formal process designed to give the board a balance of independence and diversity of skills, knowledge, experience, perspectives, and gender among directors so that the board works effectively. What we were looking for there is how the organization goes about doing that. Yes, a lot of organizations publish a skill mix for their boards, and they actually then they just say this is a skill mix of our current complement of directors. What many companies didn't go on to say was, well, how do they use that skill mix? How does that skill mix match to the competencies that the company believes it needs at board level to take it into the future and to deliver its current strategy? How does that skill mix inform how appointments to the board are handled? So yes, the skill mix is there, the competencies are shared, but the how is the information used wasn't actually very well reported. The other principle, reinforcing loyalty and independence of directors, that includes, for example, the board should undertake an assessment of its independence on an annual basis and disclose in the annual report whether each non-executive is considered independent. And this is a bit of a tricky one because you have many situations where directors are on the non-executive directors are on the boards for more than 9 years. And there's a 9-year, there's an international standard, and there's a requirement in our particular code that after 9 years, someone is not regarded as independent. Of course, they will always be, if they're non-executive, they're non-executive, that doesn't change. But if they're on the board more than 9 years, they're not technically defined as independent. And now, why is that important? Well, in some codes, particularly the UK codes, your audit committee is supposed to comprise exclusively independent directors. Your nomination committee, the committee, whether it's called a nomination committee or not, that determines the remuneration of the executive and the chairman of the board, should have a majority of independent directors. So there are particular roles and expectations with regard to the role that independent directors will play in the leadership of the organization. So it's important to understand which of your directors are independent and which of those are approaching that or past that 9-year watershed. And let me underscore here, it doesn't mean that someone, clearly does not mean that someone suddenly becomes an ineffective director. If they pass the 9-year watershed, that's not the idea. The idea is to say, well, hold on, there are special duties and responsibilities that fall to independent directors, and therefore you just need to monitor in terms of how you refresh your board, and when you refresh your board, that balance between the independent and non-independent directors. The next principle, fostering accountability, that really looks at the board on an annual basis should report to shareholders and stakeholders on the external auditor's involvement in non-audit work. This is just one of the examples. There is a very strong movement taking place internationally to actually break up the top 4 accountancy firms, not because they have done anything bad in particular or people have something against the accountancy firms. It's just that when looking at the most recent corporate scandals, there has been a sentiment and a feeling that had the auditors been separate from doing work, just had focused on audit and not on some of the other areas that generate management fees for them, they might have been a bit more aggressive with regard to some of the audit failings that were witnessed. I mean, I would say the jury's out, but let me say there is a strong movement internationally now to actually create what may be an audit authority within each of the, particularly in Europe, that actually only focuses on audit and the quality of audit, and creates a separate business for any other management consultancy work. And most definitely the code of ethics for the accountancy bodies, it very much steers your auditors away from getting involved in any type of work for the company that could involve them in management decision making. Sometimes the line is pretty thin, but it is there. So when the code is looking at fostering accountability, one of the areas it looks at is, are the companies declaring any non-audit work that they've asked their auditors to do? And if they are doing so, do they have a clear policy in place overseen by the audit committee that says, okay, in these circumstances, we will entertain our auditors, our external auditors, in getting involved in non-audit work. And outside these circumstances, we will not do that. So when it looks at fostering accountability, the code is very clear that, and that's just one of the elements of fostering accountability. When we look at strengthening the relationship with shareholders, it's talking about on an annual basis, does the board report to shareholders and stakeholders on what work has been done? Do the shareholders have an opportunity to have their views expressed and entertained? And very much, of course, you would expect that the annual general meeting that is held is something that figures very strongly in the code within this section, within this principle. The fact that the annual general meeting is not only legally held, not only legally required, but an approach is taken to it which encourages shareholders to express their opinion and stakeholders to actually get involved in what the company is reporting. So overall, we thought there was a very high, well, except for the dip number 2, a very high compliance with the Trinidad and Tobago Corporate Governance Code, which we took to be a very, very good and strong sign as the healthy approach to governance within the listed companies on our stock exchange. The next area I'd like to touch on is gender diversity on boards, which is a passion of mine. So why I have a captive audience, I will dwell on it for at least 2 minutes. The business case for diversity on boards, not just gender diversity, but diversity of thought, diversity of background, diversity of education, I think has been beaten to death. I think anybody who's asking for the business case to be made has not been reading their corporate, financial, strategic, or any other press for the last 10 years. So the case that diverse boards, not just gender diverse boards, let me say, diverse boards make better decisions, and the relationship between the ability of the company to forge ahead, to manage risks, to be successful, is positively related, positively correlated with the diversity of the thinking, of the experience, of the age, of the gender of your board. And when we look at the gender balance on the boards of the Trinidad and Tobago listed companies, as given in their 2020 annual reports, this is what we see. We see Angostura leading the way, 80%. So 4 out of their 5 directors are women. National Flour Mills, National Investment Company, Whitco. This is 2020, and I know at least one of the banks, which is Scotia, has actually hit the 80% mark for the 2021, for their 2021 report. They will really rocket up the chart next year. And as I say, I'm really talking about gender diversity, but here's the performance of the overall of all the other companies. Yeah, see Angostura leading the way. The international benchmark is that you need to have 30% of any underrepresented group for their voice to be heard. So if it's women, you need to have at least, the studies have shown, for their voices to be heard and their concerns to be registered, you need to have at least 30% of your board women. And in the UK, for instance, the target now is to get to 40%. And let me say, it is not just about 40% at board level. It's about 40% in leadership, which includes the board and the people who directly report to the board. So you have, if you don't do that, then you don't have an executive pipeline that will keep you'll keep that representation strong. So what we have seen, I'll just finish on this point before going to my food for thought. What we have seen, those of us that have been following this for a while, is that there has been a significant movement in terms of the proportion of women on boards. However, the movement has been in the category of the non-executive seats, not the executive seats. So getting an increase in the representation of executive women on boards still is proving to be a challenge. Again, something we'll pick up in the question and answer session as we go forward. So we'd like to close, myself, speaking on behalf of myself and Kamla and Ron, with some insights and food for thought. And I'm sure you'll be able to add to this list. The list can be copious, but these are the ones we'd like to share with you. We really do think there's a need to standardize non-financial reporting to enable the consumers of corporate reports to better navigate the volumes of data. This may sound strange, but I actually enjoyed reading all of those reports. I mean, I did yawn a bit when I saw 130 pages, 140, but actually when I got into each of the individual reports, and I think Kamla's experience echoed this as well, they were really interesting reading, I have to say. But we do need to standardize. We need to look at how we adopt ESG reporting standards. Now, ESG is not a settled sector as yet. There is the reporting standards, there's still competing standards, and that needs to settle. But the focus on integrated thinking and defining impact, not just activity, is something that is going to prove very compelling as we go forward. Of course, we need to update the local corporate governance code to reflect the latest thinking with regard to diversity in leadership, shareholder activism, and the stakeholder perspective. I mean, in the UK, one of the duties of directors right now is to demonstrate through their annual report and directors report how they have taken the stakeholder perspective into consideration. It's moved way beyond just saying, let's talk to the owners of the company. Now it's about talking to all of the people impacted by the company. Make compliance, and this is a plug, a personal plug, I think we should make compliance with the local corporate governance code mandatory for attaining a stock exchange listing, as well as maintaining the stock exchange listing. That happened. Jamaica has just issued their corporate governance code, and they've chosen not to go down that line, I understand, but I know there's some Jamaican colleagues on the call today. The UK has definitely gone down that line. And let me say, compliance with the corporate governance code, the model that's been adopted in the Caribbean mostly, and in the UK and Australia, is one that it is voluntary, right? It is not mandatory. But let me say also, if I'm going to be very honest with you, that's a misnomer in the UK, because the complying with the code is voluntary, but then for listed companies, the stock exchange has made it mandatory for your listing. So yes, it is voluntary. We will see that all the headlines saying the UK Corporate Governance Code is voluntary. However, for listed companies, the stock exchange has actually made it mandatory. So, but I do think that to promote good governance and to make it have a bite, and sometimes it does need to have a bite for some of the more recalcitrant, that we should consider making it mandatory for attaining and maintaining stock exchange listing, your stock exchange listing. Two last ones I will close with. We need to develop sector-specific corporate governance guidelines. The weights principles were developed for large private companies in the UK, and that seems to have gone down quite well. And the OECD guidelines for state entities, we can actually adapt and develop that for our state entities. In no way do we need to start from scratch. There is very good work that has taken place within other territories that we can build on. And also we need to strengthen the requirements for companies to report on non-compliance within the corporate governance code. Our corporate governance code follows the model of comply or explain, which means then you either comply with the principle and you regale us with all the detail as to how you've complied, or you tell us, well, okay, we've complied with the principle, but not the actual guidance. So therefore, we've taken a different approach to applying the principle. So the principle is always applied. It's the guidance that sits below it that you may take a different take on. But the requirement in other territories is if you apply the principle but don't follow the guidance, then you should explain. You should make it explicit in your annual report which elements of the guidance you have not followed, and therefore which steps you have taken as a company that you feel provides the same level of risk management as the guidance would have provided. So that leaves companies very free to tailor their approach to the guidance based on the needs of their company and their point of development. At that point, I'll say, thank you for your time. I hope I've provided you with a lot of interesting information, and I look forward to re-engaging with you at the question and answer session. I now pass you back to Ron.
Thank you very much, Joanne. And just for a matter of information, it is time that our corporate governance code, TNT, to be updated. Of course, it has been out since around 2013. All right, and it's definitely required some form of review and updating. And as you presented, one must consider, and someone in the audience mentioned it in terms of the focus on gender. Of course, you have established that diversity is beyond the gender issue, which is true. But you think about a company like Angostura that has 80%, and you wonder if that is not the issue itself, because it's now imbalanced, because it's no longer diverse, right? So basically, we have just flipped it in those circumstances from one dominant gender to the other. And the question or the consideration that we have to keep in mind is balance, okay? The balance as opposed to, the majority. And I think this is something that we have to be careful about as we champion diversity. We cannot forget balance among that diverse thrust that we are trying to establish, because if not, we will be repeating the same patterns on previous years, okay? But at this point,